2023 has been an amazing year so far, not just for the S&P 500, but especially for the Magnificent 7 stocks, the AI stocks, as they are up over 66% year to date. Now, this has been pretty amazing for everyone that actually owns any of the Magnificent 7 stocks. But a lot of you maybe did not get the chance to buy or own any of the Magnificent 7, so maybe you feel left behind, you feel like you missed the bottom, and you just feel horrible in general. You're comparing your own returns to your friend bought Nvidia, he's up 200%, and you're only up maybe 15 to 20%, although it's pretty amazing, but maybe you just feel frustrated in general. But this is not the way I look at it. I personally look at it that all these 5 or 7 Magnificent 7 stocks, they are up 66%. There has to be an opportunity left behind in the market. There has to be an industry that no one wants to touch because money rotates around. This is something I talk about, which is sector rotation. I've made so many videos on this topic, and it does work every single year. Like in 2021, whenever people were buying EV stocks, no one wanted the oil stocks. 2022, the EV stocks went down 50%. The oil stock went up 50% to 100%. And here we are in 2023, after the EV stocks went down 50%, now they are up around 50%. So it's just all sector rotation, not just from interest rates and other things, but mainly from what investors are excited about and what they like in general. And this is why I've been finding so many opportunities in this market. I'm going to share some of them here in today's video, but an area I've been personally looking in my own portfolio, in my own investment group, it's mainly in the small cap to micro cap stocks, especially Canadian micro cap companies. But this is an amazing chart. You could pull up a screener and look at companies yourself. But this is the ratio between the large caps and the small caps. And the US small caps have hit a 22-year low on a relative basis to the large cap. 22-year low as what it was in 2001 in terms of relative performance between the large cap stocks and the small cap stocks. So a lot of the small cap stocks have been left behind, and I believe there's pretty amazing opportunities in small cap and micro cap stocks. But what I'm gonna try to cover more in this video, and this is an area where there has been actually a silent crash. I mean, these stocks are making 52-week lows. Amazing companies that you actually know of are trading at record low valuations or at valuations that are trading below their 5-year low. I'm gonna talk about them in this video, but it's mainly around the dividend stocks. I know a lot of you are gonna leave the video, you're gonna get bored, you say, oh, dividends, who cares about dividends? Well, I don't care about dividends either. I mean, I'm not a dividend investor, but I just try to look for all opportunities where I can make money. If it's dividend stocks, if it's growth stocks, if it's crypto, although I never owned crypto, if it's, something crazy, some foreign stock or whatever, I mean, whatever I can do to generate returns, I'm gonna look over there. And in my opinion, dividend stocks are no longer boring. There's a lot of pretty amazing opportunities within the dividend stocks. I'm gonna give you one example of, something that would maybe shock you a little bit. This is a company that you know, and this is Coca-Cola. Now, this is the multiple, the forward PE ratio of Coca-Cola. Coca-Cola's PE ratio right now is sitting where it was sitting at in March 2020 whenever it was crashing. It's sitting well below the 5-year average. You could look at the chart of the stock. It has been a disaster so far. This is Coca-Cola, not some crazy companies that you don't know. Now it's sitting at 21 times earning, and it traded as high as 27 times earnings. The multiple is, again, pretty close to where it was crashing in March 2020. Now, why is that? Because the dividend of Coca-Cola is not a growth company. It's more of a safe company and a dividend stock. And investors, they don't want safety in 2023. They want to take on risk. They like AI. So a lot of the safety stocks, even the defense stocks like Lockheed Martin and others, I talked about them. Again, anything that's pretty much defensive has been very, very weak in 2023. Anything that's risk on like Palantir and Nvidia that get investors excited have been performing amazingly well in 2023. And this is just normal. This is what happens. But the best time to buy Nvidia, in my opinion, was in 2022 when no one wanted it. But the best time to buy dividend stocks, I believe, is right now in 2023. And I'm going to share with you exactly why. Now, one of the reasons why most people, they don't want to own dividend stocks is because they don't have to take the risk and own dividend stocks. Why would you buy a dividend company yielding a 5% dividend while you could get the same exact dividend yield, pretty much 5 or 5.5%, even with CD accounts at Fidelity, or something like with short-term treasuries or short-term government bonds, or even in your broker account, just sitting there and doing nothing. A lot of them are paying 5% interest. So why would you take on risk and own dividend stocks? This is why they have been coming down. You could look at the massive increase in federal funds rate. Now the federal funds rate is pretty close to 5.3%. I mean, this is pretty high, higher than it was pretty much in 2008. It's about to approach something like the scary 2001 levels. This is a massive, massive increase. But again, you have to ask yourself that over the long term, over the next maybe 1, 2, 3, or maybe 4 to 5 years, are we going to have 5% interest rates forever? I mean, if we look at history, history doesn't tell us that. It tells us that we have massive spikes, and then normally interest rate makes a new low. Although they have bottomed at zero, I mean, I don't know if they can go below zero, but we tend to have a pretty sharp spike in interest rates for a while, and eventually rates have to come back down. And I believe this time is no different. We have a massive spike in interest rates, but investors invest and they act like we're going to have 5% forever, which is why they avoid the dividend stocks. But in my opinion, we're not going to have 5% interest rates forever. This is not just my opinion. It's also the Fed's opinion. If you look at the longer term neutral rate of the Fed, this is the dot plots where they vote on what they believe the appropriate rate is. And this is what they have even for 2025. For 2025, they have it somewhere around 3.2%. For the longer term neutral rate, so the base interest rate, should be somewhere around 2.5%. Now, this is more than 50% less than the current, interest rates that we have, which it could make a lot of dividend stocks look attractive. Maybe in 2025 or 2026, if we have 2 or 2.5% interest rates, this 6% dividend yield that you're buying right now is going to be very, very attractive a few years from now. But most investors, they don't believe that. They don't think this way. They just believe that whatever is happening right now is going to keep happening forever, which is why, again, we had the massive crash in growth stocks in 2022, because people in 2021 believed that we're going to have 0% interest rates forever, therefore we just pay any price for the growth stocks. This is how these things actually play out. And we do have, again, a massive debt problem, which I believe will eventually prevent the government from having 5.5 or even 6% interest rates forever, as over $7.6 trillion of government debt, which is around 33%, is maturing next year. I mean, this will, of course, be putting pressure on interest rates and interest rate policy, in my opinion, even though Powell claims that it's not going to do that, but I believe it will. But again, we have the inflation problem, and it could potentially get worse. I mean, if you look at crude oil, it has been up a lot over the past months. It went from something like $78 to $91. I own an oil stock in my portfolio. It's up a decent chunk, but oil has been going up. And normally whenever oil starts coming up, then all the other commodities, they tend to follow oil. So we might have some kind of a reacceleration in inflation, even though it has been stabilizing. If you look at the core PCE, now it's at 0.2%. This is a massive, massive improvement from 0.3 to 0.4%. I don't know if it's going to be like that forever, but crude oil is starting to go up. If this stays the same, then again, we might have some kind of a resurgence in inflation, which is why this quote is very important that I'm going to share here in this video. And most of you actually know this quote. I mean, I don't have to talk about it, but this is that the stock market is a device to transfer money from the impatient to the patient. But most investors are not patient. Most investors, they don't want a dollar cost average down. Most investors, they want to compare themselves to Nvidia and other investors so they can, somehow, they just feel worse about themselves. But again, the thing I ask myself is, are we going to have an Nvidia every single year? And is that person going to be able to pick Nvidia every single year? So my answer to that is most likely not, which is why I try to stick with my own strategy, which I believe is more consistent over the long term. And this is what I would, personally encourage you to do. But you have to be very, very patient if you're trying to buy dividend stocks as the Fed is hiking rates, and they could hike rates further, which could decrease the value of a lot of the dividend stocks. So you have to be patient and you have to be disciplined in terms of dollar cost averaging down. But one stock, to me personally, that's starting to get very, very interesting. I've been finding it interesting for a while, but for my own taste, it's starting to get interesting. And this is realty income. Now, again, I couldn't care less about dividends, but I believe realty income is starting to provide a pretty decent return that I'm going to share with you in this video. But if you just look at this chart of the price to AFFO per share, I mean, it's trading pretty close to March 2020 lows. This is the silent crash that I've been talking about, that these dividend stocks, the REITs, have been falling down so much. And if you believe that we're not going to have 5% interest rates for 10 years, then these stocks are going to be very, very attractive a few years from now. And you're likely going to get paid a decent dividend yield if you actually want to wait until the tide changes and until interest rates get lower in the future. But the multiple is low on realty income, which could give it a multiple expansion in case interest rates do go back down. But if they don't go back down, now the dividend is around 5.7%, pretty close to a 6% dividend. For me personally, realty income is extremely interesting above a 6% dividend, because then I'm getting a 6% dividend and then the company grows 3 to 4% of FFO per share every single year. So with the FFO per share grows and then the dividend yield, assuming no multiple expansion or contraction, I would get something like a 10% return every single year, excluding any potential multiple expansion or anything crazy that could potentially happen. Now, in my opinion, this is a pretty amazing return if I'm parking some cash in something like realty income. It's better than the put selling strategy that I've been doing. You know, I could just put it in realty income and collect 10% to wait for interest rate to go back down. So above 6% yield realty income is extremely interesting for me, and I have been monitoring it pretty much every single day. You could ask people that know me in my own Discord. I mean, every day I look at this stock, I'm like, when is it gonna hit 6%? I'm not in rush to buying it because I've been finding better opportunities. I've been buying other things in the market. But another stock I shared before, which is starting to look, again, extremely interesting, more than it did before. I'm gonna do an update on it later in the month. And this says MAA, Mid-America Apartment Communities. I mean, just look at this chart. Look at the FFO multiple. It's sitting at 16.4 times FFO per share. This is as low as it was in March 2020. Now, I mean, again, this is astonishing to me. I mean, I can't believe the things I'm saying within the REITs, how much hate there's on REITs and a lot of the dividend stocks. You could look at this company. It has massive diversification within the high growth areas like Florida, Texas, Georgia, Nevada. They literally have a same store NOI growth of something like 13%, 9%, 6%, 5%, even 4%. They raise rents like 5 or 6% every single year. I mean, without even having to do any acquisitions. A lot of the organic growth within MAA, within the high growth migration areas. Now, they did hike rents a lot in 2022. Now in 2023, it's going to be flat to declining. So the market is freaking out. This is pretty normal. 2024 is going to be different. I mean, I believe they're going to still be able to hike rents at least 2 to 3%. This is excluding any potential mergers or acquisitions or any apartment buildings that they decide to build in the future. So this is another one that's a high quality apartment REIT. In my opinion, that's actually trading at a discount. You have a lot of other areas within the dividend stocks, which I don't personally like, but a lot of people like the utility companies. Something like AEP is yielding a 4.5% dividend. This is one of the highest dividend it traded at over the last 5 years. So I personally believe there's an amazing opportunity hidden beneath the surface, hidden outside of the Magnificent Seven stocks, a lot in the dividend stocks, in the small to micro cap stocks, even in healthcare names, retail names, because of the theft that's happening. I mean, there's just so many opportunities in this market, but you have to be patient because the market might not agree with you immediately. I mean, you're not going to buy the stock and then suddenly all the Magnificent Seven stocks are go down and your dividend stocks are going to go up. This is a process. It might take maybe next year, maybe the year after, but you have to have your own conviction, not let the market tell you what to do, but have your own thesis and stick to it. And this is what I've been personally doing in a lot of the stocks that I've been buying. A lot of them have actually gone up a lot in 2023, but I have some stocks that I'm actually negative on, and I've just been patient on the thesis, reevaluating to make sure I'm not missing anything. And I've been just, buying the dips whenever, they get big, maybe 8 to 10% dips. If it ever gets there, this is when I normally try to dollar cost average down. So this was my opinion on what's happening in the market and the opportunities. This was not financial advice, of course. Thank you for watching the video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.